Welcome to the next episode of Doing Insurance Right. My name is Scott Jenkins, your host. I'm a farmer's agent from Ahwatukee/Phoenix, Arizona. And in today's episode, we wanted to go over one of Farmer's hottest life insurance products, and that's going to be the Farmer's Index Universal Life. This is by far and away our most popular permanent whole insurance product that we sell. So just wanted to kind of run through what it does or what it means and things of that nature. So it is a whole product, so therefore it will be, as long as you don't change anything and you keep the policy funded, is what they call a guaranteed death benefit, because you would pay this until death. So whatever we select as the death benefit, so if it's, let's say, $75,000, $150,000, $250,000, as long as the premium is met every monthly, or if you pay yearly or however you pay for it, then that will be taken care of. The other thing that it does better than the other whole policies that are out there is its growth for cash value. So for example, it matches a couple of the two indexes it matches are either the S&P or the Russell index. So you have a couple of indexes to choose from there. You can split them up. You can choose one over the other and vary on how much you want of each. So therefore, you got a lot of choices when it comes to how to invest that. The beautiful thing about this product is, for example, if the S&P was down 5% for the year, you lose no money. The worst you can do is gain 0% when it comes to cash value on your money. So that's a great option there. So the only option we have is to go up. Typical growth has been in between 3 and 6%. And when we're talking 3 and 6% with a guarantee of nothing below zero, that's fabulous. It's better than where else you can put your money. And not only that, with the tax benefits of being able to withdraw or borrow against at 0% after 14 years with the policy, there is a ton of benefits with this and tax and way to get around taxes as well. The next part is going to be, there is a cap on this. So let's say the S&P did go up 15% for the year. The max that farmers will pay is 10%. But remember, they also take, if there's a loss, they are also going to take the loss and not make you pay with them. So it's a great plan to build cash value, especially if you're a younger person. It's a very inexpensive plan when it comes to a whole policy as well. And then you could take some options, such as there's a MEC option, which basically gives you the max amount you can put in the policy to fund it for under tax reasons in order to maximize cash value. So I'll give you an example. At a 20-year-old male, $75,000 death benefit. The minimum policy amount was $27 just to cover the $75,000 death benefit. So really inexpensive just to cover that death benefit. Could pay $27 for life and have that $75,000 when he gets a family and gets married. Or what he decided to do is we could do what's called the MEC on that, which is the max we can put in. It was $125.50 a month. So estimated at a 3% return at age 65, for example, $265,000 sitting there at age 65. Now, we all know that age 65 is not going to be the retirement age by the time the 20-year-old gets there, obviously. I wish I was 20, right? And know what I know now anyway. So at that $125.50, he's going to have $265,000, where he can probably retire early, because retirement age will probably be 70, 71 at that point. So therefore, an early retirement present, or continue to roll that. And the more we get closer to 70, then all of a sudden we're in the $500,000 range, where we're going to be 8 to 9 times our total cumulative premium that we've put into the policy. Not only that, we've had to get the death benefit the entire time. So if the unthinkable happens, that's there as well. Now, one thing that does happen, for example, if he was, somehow he died at age 45, any cash value that's in the policy plus the death benefit would go to his beneficiary. So you get both when you do that, but it's like a huge savings account for that reason. So another great way to do that policy is on a newborn child. So for example, at day 15, we can write this policy for a newborn child. It's $50,000. It would be the death benefit part. That's not what we're actually using it for. So if we choose the MEC option here as well to fund this policy, here's the beauty of it. So you want to save for college. So at $54 a month, 18 years old, all of a sudden now at 3% return, we have over $100,000 in there that we can can withdraw for college or borrow against it 0% to keep that fund active. So there's some great options there without having to put it into a college education fund that does not make near the return that this one does, and continue to have the death benefit in case the unthinkable happens with your child and things. So there's a lot of big pluses with this policy. Not only if you threw the death benefit out of it, it would still have some huge pluses and advantages for you. But when you add that as well, it's kind of a no-brainer. Under 18 as well is a fabulous one if you can get juniors on this program, because there is no medical. So therefore no blood, no urine on that. And it's very simple process to get them approved. So it's a great way to make sure that they have insurability, at least one insurance policy down the road. We never know what kind of, things might happen. There's a lot of, diabetes. Obviously diabetes is a big one that's out there. There's a lot of ADHD that causes some problems, especially with today's youth. So therefore, this one would guarantee an insurance policy for somebody under the age of 18, and it's very inexpensive. And the one great thing with it as well is that you can help pay for that until your child gets established, and then you can turn that over. So you could be the owner and the beneficiary of that policy. Then once, let's say they turn 25, 26, they have a job of their own, they have a place to live, then you can transfer that policy over and make them the owner and the beneficiary of that. Also on this index universal life, we can change one thing per year. So for example, if we needed to lower the payment or raise the payment, so if we didn't take the MEC option to make total cash value, but now we're making more money and we wanted to do that, we could go ahead and do that for a year or two. And then if we needed to lower it a little bit, because let's say we've got a couple kids now, money's a little bit tighter, we can do that as well. So there's going to be some great options there for you. That you probably want to look over and discuss with your agent or myself. That's just a few things I wanted to go over with the Farmers Index Universal Life today. I wanted to thank you for joining us for this episode. Once again, if you could subscribe, review, or rate this podcast on whatever platform you're listening to, whether it be iTunes, the new platform of Pandora, Stitcher, Spotify, Google Play, any of those would greatly be appreciated. And once again, we look forward to seeing you on the next episode. Talk to you soon.